Well, thank you so much, Mark, and I'm excited to be on the show again because I love giving so much education to the community. But I'm super proud of the initiative that we did with the Mental Health Foundation. It's a Stronger Together Foundation that we help support Grand River Hospital, which now has merged into the new hospital, St. Mary's. But the foundation and myself have come together to raise funds for the hospital, specifically the youth and mental health division, looking at raising funds to develop a new triage center to help youth when they first come in crisis. So I'm excited for that. We've been working on this the last 2 years. I've had two very successful events in the community and looking forward to building more and more.
Okay, well, I applaud you for that because you're someone that likes to give back in the community that you live in. That matters to you a whole lot. ValcoFinancial.ca if you'd like to look up more information as we go about the next while and talk about different topics. And of course, you can always contact them at 519-745-8019. There's a podcast, Beyond the Mortgage, and of course, you're on socials, Tracy Valco on Instagram as well. We'll repeat that later if you want to forget that. Let's start here, and I feel like this is a biggie right now that I bet people ask you every day. What's the current state of Canada's real estate market?
Absolutely, yeah. It's a question I get asked quite a bit, and I think real estate is such a hot topic in a normal market, but given especially the market that we're in right now, it is ever changing, and specifically this year, I think over the last 30 days, we've seen home sales fall about 4.8% nationally. Across the country, we're looking at home prices. The median value, which is taking consideration detached, semi-detached townhouses and condominiums, is $678,000, and that's down from March of last year. So that's down by 3.7%. It's something that I'm not surprised about. I think there's a lot to attribute to. We've had an election that just finished in Canada. We have tariffs that have been looming and adjusting, and we're trying to get used to or seeing what's going to happen with that. So I think a lot of people were hawkish in terms of being able to look at buying properties. So the stats don't surprise me. The trend of from the time that you list a property to the time that you sell, on average, is about 18 days, which to me is a fairly normal market. Like I've seen longer in a busier market. So I think that still says that there's still not enough inventory out there. But inventory is rising across the country, and I think it's different from province to province. I also think that when you look at values of properties, because we look at it from a Canadian perspective, every province is very different right now, where usually you see a trend almost the same. Right now, which holds the most and vast population, is BC and Ontario. And that's really when you look at that median value and you're seeing sale prices go down and the number of listings, it's really because of those two provinces. But the other provinces are actually doing quite well. I'm not going to break down everyone, but I think when you look at like Alberta, for instance, they're up like 4 to 5%. When you're looking at PEI, they're actually up 7 to 8%. In Newfoundland, they're almost up 20%. So you can see where people are actually migrating to. Winnipeg, like I'm giving you just specific areas too, like Winnipeg, Saskatchewan, they're up 7 to 8%. Yet when you look at BC, they're actually down 5%, and in Ontario, we're down 4%. So that brings down the actual national average to actually 4%. But the extremes are there. And when you actually like separate it, you can really see what's happening in the market. So the trends are that now the forecast is we're going to stay fairly flat on values, but realistically we're not when you actually break it down province to province.
Okay, so for buyers and sellers, especially locally, they're hearing these national things, but do they have to keep their focus locally? What should we be listening for and paying close attention to? And maybe how often? Because if you do it every day, it's a yo-yo.
It is, Mark. And the problem is that if you do it every day, it's going to stress you, right? Like it's a reality. The market's vastly changing. And there's so much information on social media now. I find that when we speak to clients I really read a lot of comments that people make on different platforms that have a huge following on social media that do talk about real estate, people are very traumatized what's happening. And then what do is they freeze, right? They don't make decisions when maybe they should actually take advantage of opportunity. I think when you look at it from a regional perspective, Kitchener-Waterloo, values have actually dropped in our area, but and that's like in marginally, like detached homes have dropped like 3.1%, townhouses have dropped 1.1%, and actually condominiums went up 4.6%. But still, overall, we have a lot more listings than we traditionally have had. In fact, our listings, and this is people like listing their house to sell, has gone up 50% than last year in like I'm going to go January.
Okay.
And I think that tells you in that type of a market. And when you look at actually kind of looking at regionally, and then again going back to Canada, they talk about, is it a buyer's or seller's market, or is it balanced? Most of the provinces are actually balanced, but here in Ontario, and I'm going to say Kitchener-Waterloo right now, it's a buyer's market, right? Because there's a lot more
Sure.
listings,
Yeah.
right? Like there's almost 1,900 listings right now in our area, which has gone up drastically in the last probably 2 months. We were at about 1,300, now we're up to 1,900. That's a huge amount. That could be correlation to a couple of things. It could be people coming up for renewal on their mortgage. There's like 1.2 million of mortgages coming up this year for renewal, and people are feeling the impact of higher interest rates, and maybe their incomes haven't gone up, which is most people in Canada. They're finding that the payment is too high, just managing everyday life. So it could be that they could be selling and downsizing. It could be the baby boomers that are looking to retire and downsize and move, right? And it could be that, people have made life changes and they need to make an adjustment and sell their house. And a lot of people are looking at other provinces because of affordability and lifestyle, not only for themselves, but their children.
Because there are pockets, right, that
exactly.
are just, obviously the prices are different, and they're sort of anomalies, I suppose.
Absolutely. But I do think that there is a segment here in Kitchener-Waterloo that the detached housing market, when I speak to a lot of realtors and clients, when we're assisting them on the financing side, we're seeing that more people are buying detached. Families are coming together to move into a bigger household so that unit stays together longer, but is also able to pay down the mortgage faster. They can afford to split the costs of everyday life, owning a home. So I think that's a big thing as well. They stay in that house longer, where traditionally we saw people, especially in our region, I found over the years, people would sell their house within 5 years. We're not seeing that much anymore. It becomes a generational home because they're buying that $1 million property. So I'm seeing more competitiveness in the detached market, but it just depends on location in Kitchener-Waterloo. Where's the house located? Is it in a good area? Is the house marketable? Is there a lot of work or not a lot of work that needs to be done? And that can help or deter people from buying that property.
How much of what we have in the area when it comes to home ownership is people that potentially couldn't afford Toronto, so they're commuting there, and they've decided this is within drivable distance?
That's a great question. And I think if you looked at it, I would say almost 3 years ago, that statistic would have actually been quite large, because a lot of people from the GTA were moving here because of affordability. Our values they were starting to go up, but they were still a lot less than the GTA, and we're still less than where, downtown core Toronto is right now. But people were able to work from home. There was more of that hybrid approach. Obviously, COVID was here, and then people had to work from home, so they were moving out of the Toronto area. But I'm finding that when we're talking to a lot of clients now and speaking to realtors, and just because I go to a lot of national conferences, you're not seeing a lot of that movement anymore, where people are coming to the Kitchener-Waterloo area because they find it more affordable, or they're allowed to work from home. In fact, we're seeing more companies wanting people to move back into their office space at least 3 times a week now. They're almost getting forced to do that. And because employment has become harder for people to find, our actual unemployment rate in Toronto is over 10% now. Yet the average is across Canada 6.4. And I think that's, people don't know that. If they actually knew that, and I know because I talk to a lot of people that are looking for employment, and for every application they put in, that job is getting 500 to 600 applicants. right? So it's just shifted so much. So I don't find as many people migrating here, but I do see that people will still stay here because they've been rooted here, and maybe their family, their family dynamic changes a bit. They bring, their kids come and move back home. I think that when I look at it in actual other areas around us, such as like Guelph or London specifically, so London, Woodstock, Oakville, if we go closer to GTA, they're hurting more on their values because they have way too much supply, and it's become, in certain areas, it's become unaffordable.
When it comes
Absolutely.
to housing?
Absolutely. I think that a lot of the initiative, when you look at the campaigns on the election, whether whichever party that you compared it to, a lot of their campaign programs were about housing initiative,
We're
creating
going to build houses. We're
exactly.
going to build more, right?
Yeah, build, right? And I think now that we know, obviously, the Liberals are in Parliament now, their focus was on affordability and fairness. That was their main platform when you looked at housing. So a lot of the initiatives that they're looking to bring in, and I'll list them just so that the audience has an idea of what could potentially be coming. Now, we have to remember this is a minority government, so they still have to get approval by
We
the
can't
other parties.
assume it's just going to happen.
Exactly,
Okay.
exactly,
All right. So
right?
what are some of the,
Yeah.
the things?
So one of the initial campaign promises was to have no GST on new homes under $1 million, and that would be for newly built homes. So we're looking at helping builders build more because it's been challenging in this market and because of costs and interest rates, affordability. So the removal of the GST on a priced home of a new built home for a first time home buyer under $1 million, that could equate to about $50,000 off the price point,
That's
which is
significant.
listen,
Yeah.
everything helps, right?
That could be the work that needs to be done. Yeah,
Exactly,
So sure.
exactly. Now the other program they have is called Build Canada Homes program, and this is the goal is to double the number of homes built to 500,000 units with a focus of affordability and modular housing.
Doable? I mean,
I
when you
mean,
look at
we're
the
not
timeline,
even,
You look at the timeline, right?
yeah, we're not, I mean, they're looking to do 4 million homes by 2035. We were, before the election, they were talking about 3.5 million homes that were short. Now they're looking to build 4 million, but we weren't even on target to build what we actually needed. So I mean, it's a great initiative, I think. I don't know how realistic that is because you have to look at the trades. We're already short on actual skilled trade laborers, right, in our country. And we also have cut back immigration. So a lot of people that were actually here, and you can see it in the community, a lot of people have actually gone back to the country or maybe another country to live because they just haven't been able to find grounding here because of lack of employment and lack of housing. Right. So I've seen a big shift actually over the last 6 months, especially in our community. So I think, when you look at immigration, we do need immigration, but we need manageable immigration so that we can make sure these people have jobs, that we still have jobs for the community here as well and in Canada, but also we're creating jobs that we need of skilled trade. That's going to help us build homes and help that infrastructure. So I do think it's a great initiative. I think it's going to be very challenging on that. The other issue, the other initiative they talked about was $25 billion allocated for domestic housing manufacturing, focusing on prefabrication and modular construction. So they're really looking at ways to build homes quicker. Not build in the ground, but build in like separate, like if they don't know what modular prefabrication home is that you would build it in an actual warehouse.
Right.
So it wouldn't be subject to weather conditions, and it's supposed to be more cost effective. And that way they're able to build a lot more through there. But I think there's a lot of challenges with that, taking a look at that. Like how many facilities do you have to actually build those homes
And
if
then
we're going to build that
truck
many?
them and reassemble them. Is that
Exactly.
kind of the
Yeah.
idea, right?
Kind of piece them together, right? So I know people who have done it, but we don't have enough actual builders out there that are doing that. Like it takes a while to be able to learn that and also have the facilities to be able to do it on mass demand, right? And also what's the price point at the end of it?
It sounds like you're optimistic about the idea. It's whether it's practical in,
Yeah.
in happening. I mean, it's all great to say you're going to get your kitchen renovated, but not if you can't get hold of tradespeople.
Oh, and that's the thing, right? Like, I think that's the one thing I don't see in this when I'm looking at all this is, where is the initiatives about the trades? Because we need the people to build. I mean, we're not AI on building homes yet, right?
Yeah.
So I think I think that's part of some of the challenges I think that we'll find going forward. But I mean, the thing is that they understand it's an issue. The government understands that we do have to build more homes. I think cutting back on the GST is going to help for, these new builds as well. But I also think that one of the other conversations that I wanted to talk about was, on the stress test, because the stress test was implemented in
You're
2016.
talking about the mortgage stress test.
Yes, exactly.
And
yeah.
I feel like the word mortgage causes stress anyway.
It
so
does,
why
absolutely.
not
So
call
why
it?
not,
Okay,
right?
There are things about it, rumors about the mortgage stress test. What is that?
Yeah, so the mortgage stress test, for people who don't know what that is, it was implemented by the government in 2016. And what it was there for is to help protect the buyer in case of, which we would see, are these rate cycles of rates going, increasing and decreasing. And it's specifically when they come up for renewal. So if they buy a home and they're coming up for renewal in 5 years and the interest rates have increased, how much of that payment shock can actually the homeowner be able to sustain? Or would they have to hand in their keys?
Based on household income, et cetera.
Exactly.
Okay.
So it's based on household income, current outstanding debts, right, and affordability of that mortgage amount. So the stress test is where you would have to qualify for the home 2% higher than where the current interest rate is. So for example, if the rate was 3%, you would have to qualify at 5%, not that you would be given that rate of 5% to manage your mortgage payments, but that the lender, financial institution, or bank would have to qualify you on that 2% higher rate to make sure that you could in the future sustain higher interest rates. Now, at the time when this was implemented, myself included, we were devastated because it hurt people by about 20% of what they could actually qualify for a home.
Wow.
And that actually put people, in some instances, out of the marketplace. And we got to remember, houses were a lot cheaper back then, right? They were sitting around like $450, right? In our area, like the average house price.
Yeah.
So we had to work around solutions. We had to work around maybe going to alternative lenders, higher interest rates, shorter terms. But in essence, when you look at it, as much as, for a home buyer back then and for us on the finance side, it was crippling to some extent. People were able to find workarounds. They were able to add on another cosigner. They were able to come up with more money down, maybe get another job, right? Increase their income. And we did find workarounds. And when you look at it, given where we're at today in 2025 and all the changes we've had COVID, we had interest rates drop and then interest rates spike into 7.5%. We had bank prime increase over 20 times, right, in 2.5 years. The actual stress test, I think, to some extent saved us from a catastrophe in our marketplace. Because if you think about it, if we didn't have it, you have to remember in 2021, we did 4 times worth of real estate activity than we normally would have done in 1 year.
Wow.
And we had the stress test rate. Now, having said that, rates were really low, but we still had it stress tested. Can you imagine if we didn't?
Yeah. I mean, so it sounds like it worked.
It worked
some, but in the end, it turned out to be a good vehicle.
Yeah,
for
but
protection.
the problem now is that interest rates, have cycled up. We're in challenging times. Values have still increased, 25% in some markets over the last few years. Even the balance, values have gone up and down. But still, we're in higher rate environments. We're in higher home value environments, and income hasn't increased, right? It hasn't indexed to inflation. And so what's happening is that people are not qualifying at times of renewal because of the stress test. And because rates are still higher and are expected to still kind of stay in that higher range, we need to look at the government, which is OSFI, that regulates the stress tests, which is an Ontario financial institution that regulates our policies. They're looking at ways, and they're doing a 12-month study right now to say, okay, can we actually reduce the stress test at this point? And there is talk of potentially a 1% decrease.
Oh, okay.
Okay, so there is talk. There's also talk of eliminating it off of uninsured mortgages. So that means mortgages, if you're buying a house with 20% down, you may potentially not have to be qualifying the stress test. So it's helping people afford homes, and this government is seeing that they're going to have to make some changes that way so we can afford homes. I do think it did to some extent. I think that now we're in a position where they should be looking at reducing the stress test given the environment we're in right now. And one of the actual recommendations is that from the bank perspective, OSFI is looking at reducing the number of high-risk loans that the banks approve. And what I mean by that is that they want the debt to income ratio. So the debt that the current client has versus their income looking at buying that home, they don't want it to exceed 450%. We might think that's a lot, which it seems a lot, but
It sounds like a lot, no?
it's the environment we're in right now for that. So they're reducing the maximum amount of these what they call higher risk loans, of not being able to exceed over 450% of people's debt to income ratio, so that these clients will not be able to get approved if their debt to income ratio is over that. And also it might push them, and I know it would, into potentially what we call our alternative or private space, so much higher interest rates. So if this actually does come into fruition, and again, it's a 12-month study, we could see this, and we're 6 months into this, by the way, with OSFI, so we could see it happening by the end of the year. This is what they're talking about. It could actually change the volume of the amount of mortgage approvals at the bank. And it could restrict either people being able to buy, or they have to put more money down, or get a cosigner, or again, look at what we do on the broker space. Not only do we look at banks, financial institution, credit unions, but we have alternative and private lenders. And I'm seeing more and more over the years that people are getting pushed into that alternative and private space on higher interest rates just because of the restrictions of mortgage rule policies. So that it's a bit of a concern, right?
Okay, well, you mentioned interest rates potentially trending downward. Is there advice for the two sides of the equation, the buyers and the sellers?
I think that for every person that's looking to consider to buy or sell right now, I mean, if you're selling, you got to live somewhere. So again, if you're renting, that's a totally different conversation. Mm-hmm. But if you're looking to downsize or move out of the province into, again, maybe downsizing and moving out of the province, everyone's financial situation is unique. No one's bank account is the same, and I always say that. So we have to look at your financial situation with a clean lens, but also know what your risk tolerance is and see where your cash flow is, look at where your income is, where are your actual goals for the next 3, 6 years, 10 years, where's your employment potentially going to be, are you self-employed? Like there's so many factors that we take a look at on the financing side for us to make that educated decision on whether you go fixed or variable. Now, if you look at it right now and I'm just going to go with fixed rates right now. Mm-hmm. So with fixed rates right now, a lot of people think fixed rates are still really high. But in fact, we've gone down about 30 basis points from the beginning of January. So we're currently now trending on, and I'm just going to say best interest rates right now. I'm not going to talk about the tiers of interest rates. I'll get into that in a minute. But best interest rate is if you were putting down less than 20% because your mortgage is actually insured by the government, which means it's securitized so that when you get that mortgage, if you defaulted and you missed your payments and you actually said, okay, I'm done with this house, I'm just going to walk away, right, the bank that holds the mortgage isn't responsible for that loss. It's the government. It's called Canadian Mortgage and Housing Insurance, CMHC. Okay. So what happens with that insurance is actually you're rewarded by taking this insurance by getting better interest rates. So when I quote better interest rates, that's what we're quoting. And most people are. When you look at it's what a lot of people do to get the phone to ring, right? Quote a best interest rate out there. Right. Yeah. But it's not actually what everybody gets, right? So these type of interest rates right now are sitting around like 3.8 for a 5-year fix. And a lot of people don't even know that, right? Mm-hmm. Like rates are under 4%. And it's interesting because I don't see a lot of media out there about rates coming down. It's all about the negative, right? So the thing is that fixed rates correlate to what's happening in the U.S. market. And why that matters is because our bond yields are tied to the 10-year Treasury in the U.S. And the 10-year Treasury is based on what's happening in the U.S. economy and their market. So their president, Trump, if he says something in the morning about tariffs and the market reacts to it, you could see the 10-year Treasury go up or down. If it goes down, it means that the market's not doing well. And then our 5-year bond yields correlate to the 10-year Treasury in the U.S. And what does that mean? That means that our fixed rates could potentially come down. Okay,
Right.
so I always say this to people because they think, oh, our fixed rates correlate to Canada. It doesn't. It absolutely 100% correlates to the U.S. What's going on in the U.S.
What's the best place then for people to get those rates? To find out that, oh, it has come down. I haven't checked it in 2 months.
It's making sure you got a mortgage professional that is your partner out there that gives you constant information out there. And that's why, like for us at Valco Financial, I do, like we're on our social media all the time, giving information and tools. We've got our monthly newsletter. We do webinars. I've got a webinar this week that we're doing, talking about the market, what's going on, talking to our underwriters, our call center that we have to help people because it shouldn't be your job to be able to scope this out as a client or a potential homeowner. Leave it to the experts because it could be ever changing. Fixed rates I've seen change 5-6 times in a week.
Okay, so I feel like
Right.
for a lot of people, and you may be listening right now, you're doing 8 things today, and you're thinking, okay, how do I get this newsletter? How does someone sign up for that? That sounds like a really worthwhile.
Yeah, so actually, right on our website, you can. There's a button on there says to register for the newsletter. Just put your name in there and email address, and our call center will get back to you and then put you on the newsletter list.
Financial.ca.
Absolutely, absolutely. So, and it's a great way to get the information. You don't have to go to 50 million places to find it. Because interest rates are complicated. It's not just about one interest rate like it used to be. It's based on what your down payment is, what your credit score is, are you purchasing, are you refinancing, are you up for renewal? It's tiered pricing. And a lot of people don't know that. So that's where you need to get the education on it, and someone like a mortgage professional team like us are able to assist you with that. So I do think fixed rates are coming down. Like the good news is I do. Bad news in the US is good news on rates. So here's the optimism for me.
Yeah. Oh, I love
Okay?
that.
Yeah.
Now, for a lot of Canadians that are carrying high interest debt, mortgage can help ease the burden?
Absolutely. Because a lot of people right now have a lot of outstanding debt. The average car payment in Canada is $700 and the interest rate's 8%. That's on average right now because a lot of people got vehicles during COVID and it was expensive.
Right.
It's hurting a lot of people's affordability to buy a home when you've got a car payment like that. But plus, people are so cash strapped every month. I mean, look at what inflation's done, just food alone. Everything's more expensive. And people's incomes haven't increased, it's unfortunate and it's heartbreaking to see people struggling so much. But here's the good news. Equity has built up in people's homes. If you bought 5 years ago and you haven't touched your mortgage, you haven't refinanced, and you're up for renewal, or even if you're not, I have a lot of people breaking their mortgage before they're up for renewal next year because we're looking at their financing proactively before the renewal. And we're looking at all their high leverage debt, and they're paying like double digits, like 29, 25% on Visa cards, and just making minimum payments. Everybody has the good intention to pay their bill in full, but the reality is people can't. They don't have the income, and they're making minimum payments, and they're not having the cash flow to be able to actually live life. And we give people that back. I call it financial wellness that we have because we really do create that. We help people consolidate their debt into their mortgage, extend their amortization so that they can afford the payment, and give people time to breathe in a very chaotic, 5 years we've had. And I think people have been so shell-shocked by the constant drama that we've had in this world that if we can give people a little financial wellness, it helps them calm their brain. It helps them calm their situation with their family, and they make, I think, better decisions going forward. It helps people get a better stepping stone on their finances. And then as we build more equity and we build more wealth within their monthly income, then we can look at maybe making extra payments on their mortgage to pay down that debt, that they increase their mortgage payments, and we can help them pay down their mortgage faster. But this is a great way for people to really get that, fresh start again. And I encourage everybody that's stuck right now, that feel like they don't have a hope out there, to give us a call because we've helped a lot of people in the community and actually in Canada on financing and helping them really educate them on what they can do because a lot of people don't think that they can look at their mortgage.
ValcoFinancial.ca. Valco Financial can be reached 519-745-8019. I can just imagine people leaving after meeting at your office and just going, oh wow, I didn't even look at the big picture, or they didn't know options. That's your expertise. Most people, myself included, know the bare bones about a lot of this and not what affects what. So I bet, am I right, that
Yeah,
people leave your
absolutely.
office and go, thank you, I have a new sense of calm, a plan for
Well,
it.
absolutely. It's a plan. I've seen people very emotional over it. They felt pretty alone, and I think that we've helped a lot of people. I continuously call it financial wellness, and as you know, I'm a big advocate for mental wellness, and it's all
Yeah.
part and parcel, right? So if we're able to do that, I've seen so many people come out of this a lot better because we've been able to provide that solution.
Okay.
Yeah, it's a tough one. I have to tell you, next year I'm really concerned with people coming up for renewal. I think that like there's 1.2 million of mortgages coming up for renewal. So 60%
Wow.
of Canadians are coming up for renewal next year. And they're expecting payments, they could be potentially facing payments 40% higher than where they were. Because you remember that was like rates back then when I priced it out, we were doing like 1.5 on a 5-year fixed.
But 40%, I mean,
Yeah.
I think back to a day, am I wrong, that they said your mortgage should be at maximum, whatever, 30% of your income or
Yeah.
40% of,
It's
wasn't that
not.
a thing back
It
in the day?
was actually in Toronto, it's actually 70% of your income goes to housing.
Wow.
And that's why people are just not able to do it. But having said that, I don't want people to get discouraged on that number because the 40% of your payment actually going up will probably decrease every month as time goes on because interest rates are coming down. So that spread between the time when you come up for renewal to where actually interest rates will be, given that we're going into a recession. I mean, we are. It's bottom line. Like we're going to go into recession. The U.S. is going to go in recession. Remember, bad news brings good rates. It means that rates will come down, right? So that the government can manage it. If we're not seeing income go up, which we certainly won't be seeing in Canada, they have to counteract that, and that's by bringing down interest rates to help with housing activity and values stay stable. So I do think that there's a lot of solutions for people that are coming up for renewal. We can look at it, and I've done this a lot for people right now, extend their amortizations back to 30 years. Now that might seem like, oh, I'm never going to pay my mortgage, but I tell people it's just a band-aid solution for today's environment. You're not staying at that. We're going to work towards you starting to bring down that amortization by increasing your payments when it becomes more affordable.
Okay.
Okay, and as interest rates come down, we might actually adjust your mortgage. So there's lots of different strategies. So these numbers that are out in the media, and why I bring them up is because people become very stifled and then they freeze and don't do anything. And that's why it's so important if you are coming up for renewal. I don't care if it's the end of next year in 2026, you call now. Because I've actually helped a lot of people break their mortgages now because it made sense. They were so financially strapped and their values, depending on the market they're in, is actually there today. Where in probably 6 months, we're going to see some declines in some markets, and you and I talked about that. I find specifically London, Ontario, it's a tough market. I'm finding values going down there every month. It's just a reality of where we're at. Will they go back up? Yes, but we're not in that environment right now. So we have a lot of people breaking their mortgages now to take advantage of that value so that they can consolidate their debt, get into a lower rate or a better mortgage product, such as a variable, which we're recommending a lot of people take. And it's giving people that fresh start. So renewal doesn't mean you wait till your renewal date. It's let's take a look at it now because every situation is different and every market is different.
So look a little further ahead. And as you say, breaking a mortgage, not something anyone would think might be a plus.
Yeah.
But you're suggesting there could be a plus to it. Now, what about for people that are thinking about buying in the next year or two? Are there any steps that smart financial steps they should start to take now?
Absolutely. You have to talk to a mortgage professional. You have to sit down and go over your actual financial situation, do a full application with a mortgage professional on your income, where you're currently at with your savings. Do you have flexibility if you need to increase that down payment? Do you have potential co-signers? Taking a look at every option so that when you're looking to buy, we've actually scoped out every scenario. So when you go to buy, there's no issues on financing. All it is be able to find the house that you want, the dream house that you want, or that starter home for you. And this is where I think a lot of people fail to do that. They fail to plan and they go into that emotional drive because they look at that house online on MLS, they love it, they go take a look, put a conditional offer in, and then they go to do the financing afterwards, and their actual employment really isn't what they think it is. And I mean that in the most sincere way, that a lot of people are so busy in life that they don't realize that a contract position that's temporary won't actually give them an approval on a mortgage financing, right? So
That's interesting.
yeah, so it depends, and most people have multiple jobs nowadays. It's not the standard. I've been doing this 26 years, so
Right.
it used to be a full-time employment was what everybody had, but most people don't have that nowadays. They're either temporary, full-time, or they also are self-employed, but no, not fully 2 years self-employed. And we've got lots of different options out there with financing products. We can take a look at your bank statements for your business. We can take a look at shorter term income, but you have to have a strategy to plan for that and to make sure that if I do need to help you adjust how you're actually getting paid, if I do need you to show and open up a business account, maybe you're putting in your personal account for your own business. If we've got to make recommendations, it could actually save you tens of thousands of dollars on the interest rate or the mortgage product because we've actually gotten ahead of when you wanted to buy.
How early in the planning, again, this gets back to whether I'm thinking a year out or two years out, how early should I start the relationship with you and meet to plan about something that seems so far away?
I don't think there's actually a timeline on it anymore, because I think the sooner you can get ahead of it, the better. If you're 2 years out, have a conversation with us, because a lot of people don't know the information you need. And it could be even just where to put your actual down payment. We can tell you how to open up a TFSA, an FHSA, which is a first home savings account, and what the benefit of that will be. If you start that 2 years ahead, you're so much better off,
Oh, I bet,
right? Because
yeah.
you can save so much money on your taxes, and you get a tax break, and you can take advantage every year on how much you can actually maximize those out. So there's never a time where I'd say it was wrong to come and see us if you're proactively doing it. When it's wrong is when you've actually put an offer in and then you're coming afterwards. Having said that, I mean, we've helped a lot of people in those situations, but you want to get ahead of it, right?
And I was going to say, and I think for a lot of people, myself included, you go, okay, going to be moving, going to be doing this, and so you're 3 months out, 2 months out, and you think, now I better approach the financial side. And that's
Yes,
pretty tight to selling and buying.
it is.
You're suggesting get that information earlier.
Because it's complicated now, right? Financing's complicated. There's a lot of different windows that we can move your financing in, but to know exactly where you're at, it helps give you clarity, and it might make a decision on where you pivot. Maybe you do something else with your employment. Maybe it means you get another side job. Maybe it means you hold back for another year so you can save, or we look at getting a parent to go on with you in a year's time, but it prepares for when you want to buy. And I think that's the main thing now. You have to prepare, because it's a very complicated time right now to buy, but it's also a great time to buy because there's a lot of abundance of supply out there. As I said, it's a buyer's market. You can negotiate on price point, you can put in conditions of financing, you can get a property lower. Pretty much where it was 5 years ago is where we're at today. Why wouldn't you take, if you've got the money and you've been pre-approved and you've got the financing in place and interest rates are under 4%, if you are able to put down less than 20%, why wouldn't you buy?
Some people are intimidated by the financial world. So as soon as they're approved, as soon as a lender makes an offer, they want to accept and maybe don't accept the first offer?
And I think it's always important that people know that they have the right to be able to make choices and take a look at options. But I do think it's very important that people need to trust who they're dealing with. And when you look at it, and why I got into this industry that I'm in on the broker space, is because we're able to give people options and choices. We have an array of lenders, banks, financial institutions that we deal with, so we can provide you that suite of products and educate you so that you make the right decision. You're not just going and walking into ABC Bank to get that rate and product. They're not going to tell you down the street that there's a better interest rate. We're going to actually do that for you. And so it takes the stress off of you shopping around, but you have to make sure that, that trusted partnership is there. Just like when you get a real estate agent or when you get a lawyer or your financial planner, having that team and making sure they communicate, because they all work together and they all work part and part so that you can buy that home and put that key in that door. And so it's really important that you have that group of people behind you, because you need that nowadays to be able to move forward, to be able to buy that home.
It all starts with the first contact, and there's no reason that you can't reach out right now and ask questions. ValcoFinancial.ca, 519-745-8019. I heard you say the word team, and I know you've got a great team. What do you guys have coming up?
So we've got lots of stuff coming up. This segment of time right now is all about education for the community. So we're hosting weekly webinars right now. We're actually having one this week, and that's on navigating after the election in Canada. So how do you navigate your financing and how do you move forward? So we got a full house tonight on our webinar, so I'm excited about that. Our next one is May the 22nd, and that's on fixed versus variable in 2025. And we get a lot of people coming on that one because it's hard to know, do I go fixed, do I go variable, what's the best thing, right?
What do I do? Exactly.
Absolutely. And then the 29th, we've got one this month, and that's on managing your financing in 2025. So we'll have a new series come up for June, and you can check up on our website to be able to register for those. They're great for attendance, but it's also, I'm getting a lot of great feedback from clients because it's giving people a lot of information and tools.